Welcome back, everybody. Ready for another deep dive?
Absolutely. Always ready to jump into the details.
Well, today we're tackling something that I'm sure is on a lot of your minds, especially as you get closer to retirement. Australian superannuation?
It's a big one for sure.
Yeah, and it can be a little bit overwhelming,
It really can.
especially when you start looking at all the rules and regulations around withdrawing and actually using the money you've worked so hard to save. You actually sent in a bunch of ATO documents about this, right? A whole stack.
You weren't kidding. It was quite the pile.
So we're going to roll up our sleeves and dive right into these documents.
We'll break it all down, try to make sense of it, and yeah, give you some actionable insights so you can actually, feel good about your super.
Exactly. We'll pull out the key takeaways, the things that maybe aren't immediately obvious when you're just sort of like staring at these documents. So one of the first things that jumps out from these ATO documents is this idea of preservation age, which basically means you can't just dip into your superannuation whenever you feel like it.
Right. There are rules.
Rules.
And the ATO has this handy table that they put together.
Mm.
It outlines exactly what your preservation age is based on your birth date. So if you were born, let's say, before July 1st, 1960, you can access your super at 55.
Okay.
But if you were born after July 1st, 1964, you have to wait till you're 60.
Okay, so there's a bit of a sliding scale there depending on when you were born.
Exactly.
And it's all laid out in this table, which we'll make sure to link in the show notes so you can find your specific preservation age. Now, the big question is why? Why does this preservation age even exist?
Yeah, it's a good question. I mean, it's not like they're just trying to make things difficult for people, right?
Right.
The idea behind it is to encourage Australians to actually save for retirement, avoid spending those funds prematurely and, ensure that you've got some financial security in your later years when you might not be working.
It's like a forced savings plan in a way.
Yeah, exactly. For your future self.
Yeah. But of course, as with any rule, there are always exceptions. The ATO does outline some very specific circumstances where you can actually access your demic super early.
Right. Yeah, and these aren't just random, there are very specific provisions. Like if you're experiencing severe financial hardship or if you have compassionate grounds, maybe you need to cover medical expenses for a serious medical condition,
Yeah.
things like that.
And there's also a special provision for first-time home buyers called the First Home Super Saver Scheme. You heard about this?
Yeah, I have. It basically lets you use your super contributions to help you save for a deposit on your first home. Now, it's not about withdrawing the money directly, but it's about using your super as a vehicle to actually build up those savings.
Interesting.
Yeah.
So if you're thinking of buying your first home, definitely worth looking into the specifics of that scheme. But I think the important takeaway here is that these early release options, they're limited, and they come with very specific conditions.
Yeah, it's not a free-for-all.
Right. And speaking of things to watch out for, we have to talk about those schemes out there that promise easy early access to your super.
Oh, yeah, the too good to be true offers.
Yeah, those ones. What's the deal with those?
Well, honestly, a lot of times those are scams.
Really?
They might try to lure you in with promises of quick cash, but it can really cost you in the long run.
So those alarm bells should be ringing if someone comes to you with some kind of scheme that sounds a little bit too good to be true. Stick to those official ATO guidelines.
Exactly.
Now, let's fast forward a bit.
Okay.
You've reached preservation age, you've patiently waited, and now you're ready to access your super. What are your options at that point?
All right, so you have a couple of choices. You can either withdraw everything all at once.
As a lump sum.
Yeah, a lump sum payment.
Yeah.
Or you can set up a retirement income stream, which a lot of people know as a pension,
Okay.
which would give you regular payments over time.
So it's like choosing between a big payout all at once.
Right.
Or like a steady stream of income. What are the things people should consider when they're making this decision?
Well, your individual financial needs and goals for sure. Do you need a lump sum to pay off debts? Or are you looking for a regular income to help with living expenses?
Yeah.
Everyone's situation is different.
And I imagine there are tax implications as well.
Oh, absolutely. The tax treatment of lump sums versus income streams can be quite different. I mean, it can vary significantly. It's best to actually talk to a financial advisor. They can help you understand how those choices will impact your tax liability.
Solid advice. Now, what about those people who reach preservation age but aren't quite ready to fully retire?
Yeah.
They maybe want to keep working part-time, but they also want to start tapping into their super a little bit. What are their options?
Well, for them, there's the transition to retirement income stream. We call it TRIS for short.
Sorry?
It's designed for that exact situation. People who want to ease into retirement gradually.
So you can sort of dip your toes in
Exactly.
while still earning an income.
Yeah.
How does it work?
So basically, with a TRIS, you can access a portion of your super while you're still employed. Gives you some flexibility. You could reduce your work hours, maybe salary sacrifice more into super, or just supplement your income a bit.
Sounds pretty appealing.
Yeah.
And strategically, it could be a good way to manage that transition into retirement. Now let's address the elephant in the room.
Yeah.
The thing that nobody really wants to think about, but it's important. What happens to your super when you pass away?
Yeah, not always a fun topic to think about, but it is crucial to plan for that eventuality.
So the ATO has specific rules about this, right? About how your superannuation death benefits are distributed.
They do.
So walk us through it. If somebody passes away, who typically receives their super, and how does it work?
Well, a lot of it depends on whether they had a valid death benefit nomination in place.
Right. You mentioned these nominations earlier. Can you remind us about the different types?
Yeah, so you have binding nominations and non-binding nominations.
Binding versus non-binding. What's the difference?
So a binding nomination is basically like a legally enforceable instruction to your super fund.
Okay.
It dictates exactly who gets your super benefits when you die. A non-binding nomination is more like a suggestion. It guides the trustee, but they might have some discretion in how those benefits are distributed.
So with a binding nomination, you have more control over where your super goes. What if there's no nomination at all?
Then the trustee of your super fund has to follow a specific process to figure out who gets the benefits. They'll usually look at your dependents, like your spouse, children, or anyone financially dependent on you.
Makes sense. It's all about making sure your superannuation benefits end up in the right hands.
Exactly.
This is one of those areas where talking to a financial advisor is probably a good idea
Oh, for sure.
to make sure everything's set up correctly.
They can help you navigate all the details.
Yeah. Well, we've covered a lot in this first part of our deep dive. Preservation age, early access, retirement withdrawal options, even touched on those death benefit nominations.
And we're just getting started.
There's more to come. So stick around for part 2 of our deep dive into Australian superannuation. Welcome back to our deep dive into Australian superannuation. Before we move on, I want to circle back to a concept we touched on earlier, that transfer balance cap.
Right. That's the limit on how much you can move into a retirement phase income stream, like a pension.
To enjoy those tax-free earnings in retirement.
Exactly.
So that magic number, as of July 1st, 2023, is $1.9 million. It's a significant amount, but it's there to ensure a balanced approach to retirement planning.
It encourages people to think about a mix of income sources, not just relying solely on superannuation.
Makes sense. But what happens if you do go over that $1.9 million cap? What are the consequences?
Well, that's when things can get a bit tricky. You'll have what's called an excess transfer balance.
And I'm guessing that triggers some unwanted attention from the ATO.
You bet. The ATO has a system to deal with these situations. They might issue you an excess transfer balance determination.
Okay, a determination. What does that actually mean in plain English?
Think of it as a formal notice from the ATO. They're outlining your excess transfer balance. It'll tell you how much you need to withdraw to get back under that limit, the deadline for taking action, and even your personal transfer balance cap.
So it's like a friendly reminder that you've overstepped the boundaries
Yeah.
and you need to take steps to fix it.
Exactly. And to make sure you're aware of the potential consequences of inaction, they'll often include what's called a default commutation notice.
Okay. Default commutation. That sounds a bit intimidating. What does that involve?
It's basically a heads up about which super fund and which specific income stream account they'll target to withdraw the excess if you don't take care of it yourself.
Right.
By the deadline, they'll issue what's called a commutation authority to that fund, instructing them to withdraw the necessary amount.
So it's like a backup plan to ensure that the excess is addressed, even if you don't take the initiative yourself.
Exactly. And it's worth noting that those guaranteed income pensions from government super schemes, the, what are they called?
Yeah.
Capped defined benefit income streams. They are treated a little differently. They still count towards your transfer balance, but they're not usually included in a default commutation notice because they generally can't be commuted or withdrawn in the same way.
So if you have a mix of income streams, they'll likely target the more flexible account-based pensions for any necessary withdrawals.
You mentioned the ATO calculates the amount of excess you need to withdraw. Is it simply whatever is over that $1.9 million limit? Or is there more to it?
It's a little more complicated than that. They also factor in something called excess transfer balance earnings.
Earnings. So it's not just the original excess, but also any potential investment growth on that amount.
Exactly. They use a specific formula. It's based on a benchmark interest rate to calculate these notional earnings. It ensures you're not benefiting from investment returns on the portion that's exceeding the cap.
So they're essentially adding interest to the excess to make
Yeah.
sure the system's fair.
Yeah, that's a good way to put it.
So let's say you do receive that excess transfer balance determination from the ATO. What are your options at that point? First and foremost, review the information carefully. You can also check your transfer balance account online through the ATO's website, just to confirm the details. And if you need a bit more time to sort things out, you can actually contact the ATO. You can request an extension.
It's good to know that they're willing to work with you if you need a little bit more time to get your ducks in a row. Let's say you do agree with their assessment and you're ready to withdraw the excess. What does that process look like?
You would contact your super fund and ask them to commute the excess amount. You could either transfer it back to what's called an accumulation account where it can continue to grow, or withdraw it as a lump sum.
And it's important to act by the deadline, right? The one specified in the determination.
Absolutely. Otherwise, the ATO might take matters into their own hands. They'll issue that commutation authority, potentially withdrawing from an income stream you didn't intend to touch.
So it's best to be proactive and manage the withdrawal yourself. Now, you also mentioned there's a tax consequence for exceeding the transfer balance cap. Can you tell me more about that?
Sure. It's called the excess transfer balance tax. And it applies if you've had an excess, even if you haven't received a determination yet.
So it's not just about withdrawing the excess. There's a separate tax bill to contend with as well. How is that tax calculated?
It's typically calculated on those excess transfer balance earnings we discussed, covering the period from when you first exceeded the cap until you rectify the situation. The tax rate is 15% for the first time you have an excess transfer balance, and it jumps to a hefty 30% for any subsequent excesses.
Ouch. That's a pretty strong incentive to stay on top of your transfer balance. And seek professional advice if you have any doubts.
Absolutely. Always better to be safe than sorry when it comes to your retirement savings.
Okay, so we've explored what happens when you exceed that $1.9 million transfer balance cap. It's definitely something to be mindful of. But let's shift gears now and talk about a different aspect of superannuation. It can be a bit sensitive, but it's death benefits.
Yeah, it's not always easy to think about what happens to our super when we're gone, but it's essential to plan for this.
Exactly. So let's dive into the details and demystify this often overlooked area of superannuation. So we were just talking about death benefits, which, not the most cheerful topic,
Yeah, not exactly light-hearted conversation.
but it's important to understand what happens to your when you're gone.
Absolutely, making sure those hard-earned savings actually benefit the people you care about.
Right, exactly. So let's break it down. When somebody passes away, what typically happens to their superannuation?
So in most cases, their super fund will pay out their remaining super balance. It's called a super death benefit to their nominated beneficiary.
And this is where those death benefit nominations we talked about earlier come in, right?
Exactly. Those binding and non-binding nominations. If there's a binding nomination, the trustee of the fund, they have to follow those instructions. Legally binding. But if there's no nomination or it's a non-binding one, the trustee has a bit more leeway in deciding who gets the benefits.
So having that binding nomination in place really gives you more control. But who exactly can be a beneficiary? Is it just family members?
Not just family, the ATO actually has specific definitions for dependents under both superannuation law and tax law.
Okay, that sounds kind of complicated. Can you walk us through who qualifies as a dependent under each law?
Sure. Under superannuation law, dependents usually include your spouse, children of any age, and anyone in what's called an interdependency relationship with the deceased.
Now, interdependency relationship, that's not a term you hear every day. What does that actually mean?
It's basically a relationship where two people have a close personal connection. They live together, they rely on each other for financial support, domestic support, recognizes relationships beyond just marriage or de facto partnerships.
Got it. Broader definition of a dependent relationship. What about under tax law? Who's considered a dependent there?
Tax law includes your spouse, your former spouse actually, children under 18, anyone in an interdependency relationship, and then just anyone else who's financially dependent on the deceased.
So even, adult children could be considered dependents if they were financially reliant on the deceased.
Right. But for children over 18, that financial dependency is key.
There's a lot of nuance here when it comes to dependents and death benefits.
Definitely is. And this is one of those areas where, having a financial advisor can be super helpful.
Yeah, good point.
They can help you make sure your nominations are aligned with your wishes, but also with the relevant laws.
Always better to be safe than sorry, right?
But absolutely.
Okay, so let's talk about how these death benefits are actually paid out. Is it always a lump sum, or are there other options?
Well, if the beneficiary is a dependent, they have some choices. They can receive the death benefit as a lump sum payment or as a death benefit income stream, similar to a pension.
So they have some flexibility.
Exactly. But if the beneficiary isn't a dependent, the benefit has to be paid as a lump sum.
So the method of payment depends on the relationship to the deceased. Makes sense. Now, what about that transfer balance cap? Does that come into play with death benefit income streams?
It does. Even death benefit income streams are subject to that $1.9 million transfer balance cap. But there are some special rules to keep in mind.
Ah, so it's not as straightforward as it seems. Can you break down those special rules for us?
Sure. So one type of death benefit income stream is called a reversionary income stream. Automatically passes to a nominated beneficiary when the original pension recipient passes away. For those, there's what's called a deferred credit to the beneficiary's transfer balance account.
Deferred credit, what does that mean exactly?
It means the full value of that income stream doesn't immediately count towards the beneficiary's transfer balance cap. If they became entitled to the income stream before July 1st, 2017, the credit is applied either on that date or 12 months after the original pension recipient's death, whichever is later.
So there's like a bit of grace period.
Right. And for those who become entitled on or after July 1st, 2017, the credit is applied 12 months after the original recipient's death.
Got it. Consistent 12-month deferral for the newer ones. Now, what about the non-reversionary death benefit income streams? How are those handled?
Those don't automatically pass to the beneficiary. They have to actively choose to start receiving the income stream. And it's only when they do that that the value is credited to their transfer balance account.
So with non-reversionary income streams, the beneficiary has more control over when that amount starts counting towards their cap.
Exactly. And the value they receive might also include any investment earnings that accumulated on the deceased person's account between the date of their death and the date the beneficiary actually starts receiving the income stream.
Interesting. So it's not just the original balance.
Yeah.
Could be a bit higher depending on how the investment's performed. Now, you mentioned earlier that some government super schemes, the defined benefit ones, have special rules for the transfer balance cap. Do those apply to death benefits too?
Yes, they do. They have what's called a special value that's calculated using a specific formula.
Okay, so those calculations can be a bit more complex.
They can be. And it's another area where a financial advisor can be helpful in making sure you understand the implications for your transfer balance.
Makes sense. One thing that stands out to me is that children who receive death benefit income streams seem to be treated a bit differently under these transfer balance cap rules. Is that right?
You're right. The ATO recognizes that children who inherit super are often in a different life stage than, adults nearing retirement. So they have a system of what's called modified personal transfer balance caps for children.
Modified caps. So they don't have to stick to that $1.9 million limit.
Exactly. Instead of the standard cap, children get what are called cap increments that allow them to receive those benefits without going over their modified cap.
That's pretty generous. How are those increments determined?
It depends on a few factors, like when they started receiving the income stream, whether the deceased parent had a transfer balance account before their death, and even the source of the super interest that's funding the child's income stream.
Sounds complex, but the intention is good.
Right.
Giving those children who are beneficiaries a bit more flexibility.
Exactly. Recognizing that their financial needs and circumstances are often different from adults preparing for retirement.
Well, we've covered a lot of ground today, from preservation age and early access, all the way to death benefits and those transfer balance caps. Superannuation? It's a complex world, but hopefully this deep dive has helped shed some light on the key things to know.
Definitely lots to consider, and I encourage everyone to check out the ATO's resources. They provide a wealth of information.
Absolutely. And remember, getting personalized advice from a financial advisor can be invaluable. Help you navigate all these complexities, make informed decisions about your super.
Couldn't agree more. They can help you develop a strategy that's tailored to your individual goals and circumstances.
So, dear listener, if you're feeling a bit overwhelmed by all of this, don't hesitate to reach out to a professional. It's an investment in your financial future. And as always, you can find links to all those ATO documents we referenced in the show notes for this episode.
Thanks for joining us for this deep dive into Australian superannuation.
Until next time, keep learning, keep exploring, and keep diving deep.